Students, this is a continuing lecture series for Chapter 8 on fixed assets, mainly focusing on depreciation. On this lecture, we're going to cover revisions to depreciation, and repairs to assets or improvements as well. We'll talk about that. And then disposals. The next section, actually part 5, we'll talk about depletion and intangibles. One of the things we need to understand about depreciation is that things are not always bought right at the beginning of the accounting period. What you find in accounting textbooks and in homework problems is that an asset was often purchased on January 1st of 2000 or 2010 or whatever. What that means is that they're trying to make it simple for you because that's an entire year. That's not how the real world works. Think of how absurd it would be if the finance department came and told you, well, it's too difficult to do our accounting calculations, so we're going to make you only buy things on January 1st. It's absurd. It doesn't happen. So what finance folks and accountants have to do is we have to take depreciation expense into account as to when it's bought, and then you have to put some rules in place to prorate it for a partial year's depreciation. Accounting rules say that we've got to take the depreciation expense in the period in which the asset was put into service. And so what that means is we come up with some simple rules. If it's put into service during the first half of the month, we'll take a full depreciation expense for that month. If a firm or an organization takes their depreciation by year, they don't do it month to month. They're not a publicly traded company. They don't have to do their books every quarter like publicly traded companies do. Then they could do it by year. But usually there's a rule of convention saying if you bought it in the first half of the month, we will take the full depreciation expense for that month. There's no way we're going to calculate this out by day like banks and loans and financial instruments calculate interest to the day. We don't do that for depreciation. Let's round it off to the nearest month. So what that means is if something was purchased during the second half of the month, we won't take any depreciation that month. We will just say that something bought, for instance, on October 16th was put into service on November 1st. We'll go to the first of the next month. If something's bought on October 12th, we'll say, let's just say it was bought on October 1st. We'll take a full month for October. We don't need to be doing half months or quarter months or 6 days out of a 31-day month. We don't need that detail. Okay, so that's our convention for months, and most of these are going to be by month. I hope that's clear. All right. So here's an example. What's the depreciation expense on December 31st, 1999 for a 24K machine that was purchased on July 10th, put into service on July 13th? Machine has a 10-year life and no salvage value. Okay, first of all, which date is relevant here, the 10th or the 13th? Really, it's the 13th. Okay, but because of our month convention, we are going to say that July 13th, that's the first half of the month. And I wouldn't even worry about 31-day month or 30-day month. If it is 15 or lower, just say it's in the first half. Even if it's February, don't worry about it. It's not that big of a deal, and I'm not going to give you that on a test. If it is the 16th of the month or later, just push it to the first day of the next month. Okay, so what's this look like? All right, we're going to say we have July 1st as our start date. Okay, if this number here was July 16th, we would say August 1st is our start date. But it's in the first half of the month, so we go to the beginning of the month to keep it simple. Okay, so we're going to take 6 full months, right? July, August, September, October, November, December. Those 6 months, half a year. Okay, so we're going to get full depreciation for that. If we do straight line, it's 24,000 divided by 10. There's no salvage, so it's 2,400 per year or 200 a month. Therefore, 200 a month times 6 months, $1,200 is the depreciation expense we would write on the books on December 31st, 1999 at the end of that fiscal year. Okay. So that's how you do that. But the key thing is you understand that monthly convention. All right. So how do we revise things mid-flight? Okay. That is another change because sometimes the information changes. So we can revise the depreciation schedule throughout the middle of the life of the asset. We cannot exceed the remaining depreciable value. Okay. And so you would not revise depreciation if you were expanding it out. In other words, if you're saying a 10-year truck is now going to last us 20 years, you would be delaying your depreciation schedule. And most companies don't want to do that. They want to accelerate it because they'd rather have the tax deductions sooner rather than later. Okay, so there's our 2 rules. We can revise the schedule, but you can't exceed the remaining depreciable value. Okay, so let's look at an example involving the same machine. It says above, but it means the previous slide. Okay, so 2 years into this life, let's say the company data shows that actually similar machines have a life of only 8 years. And we said, what did we say again? 10, I think, right? So we said 10 right here, and really it's going to be 8. So we're going to pull it in by 2 years. Okay, so how do we recalculate the new depreciation expense from this point forward? Okay, remember it was purchased in July 99. So now 2 full years in, so it's July 2001, right? We have to look at what the new depreciation expense is going to be from this point forward. Well, how do we do that? First of all, we have to find the net book value. So 2 years in, remember it was 200 a month. That's 24 months. 2 years times 200 a month is 4,800. There's our accumulated depreciation after 2 years. Subtract it from the original purchase price. Okay, and so this money just gives me 19,200. Now we were going to spread that out over the remaining 8 years. Okay, that's 10 years minus 2 years are gone. So had I not changed anything, this would go another 8 years. Now we're saying the total life is 8 years, 2 years of which has already passed. So there's how many years left? We're saying it's 8 years life now, 2 years are already gone, so it's 6 years remaining. Okay, so now we take this dollar amount, 19,200, the remaining net book value, and we're going to spread it out over 6 years left, when if we hadn't have done this at all, if we stuck with the original schedule, it would be 8 years left. So when we have the bottom of the fraction get smaller, the total number per year gets bigger. Okay, and it turns out to be this number divided by 6 years left gives me 3,200 a year. Well, it used to be 2,400 a year. So now it's divide this number by 12 and you get 267 per month approximately. So here's where it can get tricky, and you've got to pay close attention to details here. Go slowly and understand this when you're doing your calcs. For the fiscal year of 2001, right, the first half of the year we were ticking along at $200 a month. Now the last half of 2001, July through December, we're going to be ticking along at 267 per month. Okay, so you've got to say 6 months times this is 1,600 for the remainder of 01. Oh, and the old one was 200 a month times 6 months from January through the end of June 2001. That was still ticking along at $200 a month. So that was, I think, 800. I'm sorry, 2 times 6 should be 1,200. So when I add these two up, okay, I should get 1,200 for the first half of the year, right? 200 a month for these 6 months. Okay, from the last slide, 1,600 for the second half of the year. So the actual expense that we're going to make on December 31st, 2001 would be the sum of these. First half of the year, second half of the year for a total of 2,800. I hope that's clear. All right. Now, all future years, obviously, we would be taking, and I'm going backwards here, all future years, you would take 3,200 a year for the next 6 years. Okay. So I hope that's very clear to you. That's how we revise depreciation when the life of the asset changes. And you're rarely going to see, probably never in this class, you're going to see where the life expands. Usually the life gets shorter because they want to pull it in. There's no incentive for companies to push it out, okay, by saying the asset's going to last longer. Take the depreciation as soon as you can legally, okay? All right, so we covered all this. All right. Now we're going to talk about revenue and capital expenditures. First of all, costs that benefit only the current period are called revenue expenditures. You might hear people in finance or in business call these, well, can I expense it? That means you take the full expense right then and there, okay? Costs that are going to benefit future accounting periods are called capital expenditures. I don't know about what organizations you guys all work in, but what you'll notice is that things that are over $500 or have a life beyond 2 years typically are often capitalized. In other words, you have to set up a depreciation schedule. Okay, in the public sector, you can't even buy things without putting them in the right purchasing code, calling it capital or expense. Okay, so I know it says revenue, but that's what it means. It's an income statement. It only affects the current period. Future periods, this is going to affect asset accounts on the balance sheet. This one up here is only going to affect the income statement. All right, ordinary repairs required for normal operating condition, no effect on depreciation. It's an expense. That would be like, say, changing the oil on a fleet of vehicles, getting the vehicles washed, regular service. Those are ordinary repairs. They don't, although they make the vehicle last longer, they don't give it increased capacity, and they don't actually extend the life. Okay, so extraordinary repair, this extends the asset's useful life. This would be like dropping a new engine into a backhoe, dropping a new engine into a truck or a fleet of trucks. Those types of things can be called extraordinary repairs. The key thing here is extraordinary repair starts with EXT, so does the word extend. So we're trying to extend the life. If you're not sure, keep that in mind, okay? Usually these are debited to the asset account. In other words, if this was a truck that we dropped an engine in, we would debit the asset account, okay? And this is what it would look like. We would simply add the cost of dropping the new engine in to the equipment account and drive up the basis of that truck. Suppose it was a $25,000 truck. Well, you would just add $2,500 back into the account. Okay, so now it's a $27,500 truck. Obviously, we're going to pay cash or an accounts payable of some sort. So that's what extraordinary repairs look like. All right, now your depreciation calculations will change because you have a new book value. In other words, if we extended its life of that engine, we get to depreciate the engine as well as the truck itself. Okay, so we have to change the book value of the asset because we just changed it on the books here. And so now we got to change depreciation as well. All right, we'll get to that in a minute. A betterment of an asset is when we are actually making the asset more productive. When we add in a new component or we replace an old one, for instance, if we added some sort of new automated feature to a copy machine that makes it also do collating and stapling, something like that, or if we added a color component or something like that, a module to a machine, that would actually make it more productive. It has nothing to do with extending the life, but typically this is about productivity. Okay, so in this case, we would debit it to the asset account, not to the accumulated depreciation account. And that's, some books handle this differently, but we're going to handle it the same way. So we're going to debit the asset account again. All right, here's an example. Company spends $8,000 for a machine whose useful life is 8 years, no salvage value. Okay, 3 years in, it adds an automated system to the machine at a cost of $1,800. Okay, so 8,000 minus 3 is the depreciation. It's got a book value of 5. Right now, I instantly change the book value from 5, $8,000 minus $3,000. $5,000 plus 1,800, its new book value is now 6,800. Okay, now if this was a betterment, and notice it didn't say it extended its life, it said, it implies here that it is improving its productivity. So we don't extend the life, we simply add the 1,800 to the book value of 5,000, and now we're going to change the depreciation schedule accordingly. So there's the debit to equipment, there's how we paid for it. And now what amount do we have left to depreciate? Well, it's going to be 6,800 divided by 5 years, 1,360 a year is my new annual depreciation expense. In the past, it was, going backwards here, 8,000 divided by 8, it was $1,000 a year. Now it's higher. It has to be. Okay, we have to depreciate that 1,800 over 5 years. Okay, oh, and by the way, what's 1,800 divided by 5? I think if you do that, it'd be 360. Oh, so 1,000 per year is what it was. Now we add on another 360 per year. Well, it works. You get 1,360 per year. Okay, hope that's clear to you. Now we're going to the last part of this lecture here, which is getting rid of assets. What happens when companies get rid of these things is we're going to have to first record the depreciation up to the date of the disposal. We're going to remove the balances of both the equipment and all its accumulated depreciation. So the asset and all related contra asset accounts disappear from the books because we no longer possess that equipment. We're getting rid of it. Okay, and now we would record any cash or other assets we received or paid. Sometimes you have to pay to get rid of things, right? Pay a company to come haul off the crap in your warehouse. Okay, or sometimes computer stuff you have to pay for landfill fees. Now those are being paid up front before you get rid of them. But there are frequently costs in getting rid of assets. Companies that are lucky, if the assets have any value, they'll try to get some money out of it. Okay. So one common example of these will be trading in of vehicles, and you guys can relate to that if you've ever done that at a car dealership. We have to record, the fourth step of this is we have to record any gain or loss by comparing the net book value of the asset to the value we received, whether it was cash or some other asset. Okay, so these are our 4 steps. These work, follow them every time, and I'll show you some samples to work your way through that. Okay, here we go. Bought a machine on a convenient date here, January 1st, 2000. Cost 9,000, 9-year life, no salvage. That's easy. 9,000 a year is what our depreciation is, right? Now we're going to get rid of it. No salvage value. We're going to get rid of it from our book. So this is first example here. If it's fully depreciated and the net book value is 0, that would only happen 9 years in, okay? So there we go. If net book value was 0, then we would just say, okay, we got rid of it, take it off the books. That's the simplest example. It's fully depreciated. There's nothing else to do, and we didn't get any cash or other assets for this asset when we got rid of it. That's the simplest case, okay? More complicated case here. What if it's not fully depreciated? We still have some depreciation left to take, and let's suppose instead of 9 years in, after about 5.5 years, we get rid of this thing, and let's see what happens. First, even though it's mid-year, we would bring the depreciation up to date, even if the company wouldn't take depreciation until the end of the year. We're going to do this one mid-year just to check, okay? So it was $1,000 a year, so we take depreciation expense right now and add to the accumulated depreciation, okay? So now that we've done that, we got to find the net book value and get rid of the balances, okay? So first of all, the accumulated depreciation is 6,500, right? I might have said 5.5 years. This would be 6.5 years, because 2000 would have been the first year. Okay, so the end of 2005 would be the 6th year, and this is 6.5 years here, midway through 2006. Don't forget, 2000 was the first year, not a 0 year. So now I get rid of this stuff. I've still got 2,500 left on the books. So when I get rid of it, I still have 2,500 I can depreciate, but I can't because I'm getting rid of it. So I just take a loss. In other words, all the leftover depreciation I take right now, okay? And it's not really depreciation. I'm actually taking a loss. This is not an asset account or a contra asset account like accumulated depreciation. This is actually an owner's equity account. Okay, it closes into retained earnings, and so this is actually a loss, just like a loss you take on your income statement. Okay, so it hurts earnings, but actually it's not cash, so it actually makes your earnings look smaller, so you pay less taxes. So it can be a good thing, although you'd rather have cash for it if you could get 2,500. So the equipment's gone off the books, all the accumulated depreciation has gone off the books, but since it's not fully depreciated, debits won't equal credits unless I take this loss, and that's usually how you figure it out. If I get rid of the equipment, which I know it's purchase price 9,000, and I accurately calculate the accumulated depreciation like I did up here, okay, it was 6,000. I added this last 500 because it's mid-year. If I put that there, you can figure out what the gain or loss is by subtracting the debits from the credits. Okay, I need another 2,500 here. It wasn't fully depreciated. I didn't get any cash, so it's a loss. Okay, so that's a slightly more complicated situation of getting rid of an asset. But it gets more complicated if we have some assets to gain. If it had any salvage value, what happens? Let's suppose that we actually got 500 bucks for it. This is what the journal entry would look like. So follow your 4 steps. We already calculated the accumulated depreciation and added 500 for this year. So I got this piece and this piece. Usually in a deal like this, the word problem would tell you you collected 500 cash. That's pretty clear. So I would make the cash debit and then figure out what your missing debit here is, and that's how you can figure out what the loss was. Okay, plus, you had 2,500 of book value remaining. You collected 500, therefore it's a $2,000 loss on paper. Okay, but you're usually glad to get rid of it or you wouldn't be getting rid of it. Okay, and finally, what's happening here is what if we were to exchange assets? You can trade, you can swap, you can barter. Okay, if these assets are similar, in other words, if they're used for a similar purpose, I'm not going to go into FASB regulations of what that is. If we give up old equipment for an original cost of $3,600 with accumulated depreciation of $2,000, and you can see right there the net book value is going to be $1,600, and we paid $3,300 cash for new equipment that had a fair market value of $4,200. This is getting confusing already, right? But if we do that, look at the discount here. If fair market value is $4,200, we paid $3,300. We really got $900 of value. They gave us a screaming deal because this exchange. One of the things we have to be careful of is we got new equipment. We can't write it at the price we paid if its fair market value is higher, okay? What we're going to do is we're going to take a loss on the exchange. Remember, this was 1,800, I think, or I'm sorry, 1,600 minus 900 because I got a $900 discount. This is like the car dealer who says, sticker price is $4,200. I'll give it to you for $3,300 cash. And so you actually got a $700. Let me go back. You got $900 of value here. You had $1,600 of net book value for which you got 900, so you still have a loss there, right? So I'm getting that. 1,600 is the book value. I only got $900 trade-in value, therefore 1,600 minus 900 gives me a loss of 700. Okay, accumulated depreciation is 2,000. Get rid of the equipment here, and there's my journal entry for an exchange. The bulk of your problems in this chapter and on the exam will be on selling assets, not on exchanges. But this is a slight detail with accounting that, oh yeah, that's important. Should put that in there. This is a detail of accounting that needs to be covered, but it's not the main emphasis of this chapter. Okay. Now, if you exchange dissimilar assets, here's the thing. Okay. Or if you receive more in exchange, okay, suppose they give us even more value than our loss, then this would go completely away. Okay. If they gave us 5,200 and we actually had, we paid 4,900 for it, okay, that would change things here. Okay. We don't get to recognize the gain on this because GAAP requires the assets are recorded at cost. You can't show fair market value in the books if we didn't pay fair market value. Okay, so there's a little detail of when you receive more in exchange. But this is very, very rare because when you exchange stuff, they're not going to give you a screaming deal. Usually on the trade-in, as you know from auto dealerships, they don't give you anywhere near the true market value of the vehicle. They make money on both cars, the old one they're getting from you and the new one they're selling you. Finally, with dissimilar assets, if you get less in exchange, okay, we could have equipment that had original cost of 1,800, accumulated depreciation of 1,500, so book value of 300, and we paid 1,800, or we got $1,800 in exchange for land of 2,000. Notice we're getting a $200 discount. We had a $300 net book value, so our journal entry would look like this. We only have a loss of 100. Okay, but these won't be on the test. This is just content that we have to cover. Okay, so there is our part 4 of this chapter. There you go.